AirAsia X or AAX says it is proposing to acquire Capital A's aviation arm through a merger with AirAsia and AirAsia Aviation Group as part of its regularisation strategy. This confirms the Edge weekly report on November 7th, which, quoting sources, said AirAsia may merge with AAX as part of the restructuring of Capital A, which is also a PN17 company. The proposed acquisition is subject to the approval of the company's stakeholders and relevant regulatory authorities. Earlier this month, AAX obtained an extension of time from Bursa Malaysia to submit its regularisation plan. It expects to announce the plan in January 2023, followed by an official submission for approval in February. AAX CEO Benjamin Ismail said the move will create synergies with existing mid-range operations, although all airlines under the consortium will remain separate with regard to their operations. He said leveraging the group's wide network of over 130 destinations will provide opportunities to expedite its recovery after the completion of the regularisation plan. He added that the strategy is expected to strengthen its balance sheet and cash flows and create value for the company and its shareholders in the longer term. AAX expects to complete the implementation of its regularisation plan by July next year. Shares of AAX closed 3.5% higher at 44.5 cents per share, giving it a market capitalisation of 184.59 million ringgit. Capital A, meanwhile, closed 6.25% higher at 59.5 cents for a market value of 2.48 billion ringgit. The prosecution is understood to have decided not to file a notice of appeal against the KL High Court's decision regarding the seizure of 80 million ringgit worth of luxury goods from pavilion residences in Kuala Lumpur. 2 weeks ago, Judge Datuk Muhammad Jamil Hussain dismissed the government's bid to seize 2,435 pieces of jewellery, 7 Richard Mille watches and 29 Hermes handbags, which were claimed by Datuk Sri Najib Razak and Datin Sri Rosmah Mansor. Jamil said the prosecution had failed to prove that the items were gained from criminal breach of trust using 1MDB funds. He also ruled that there was no evidence of a predicate offence of criminal breach of trust on a balance of probabilities. The court also refused to grant a stay of the decision. Now that the deadline to file the notice of appeal has elapsed, the Edge understands that the prosecution has decided not to challenge the verdict. When contacted, Najib's co-counsel Tanya Shavetti told the Edge she has not received any notice of appeal and was not informed by the prosecution of such a notice. With this, Jamil's decision not to allow the forfeiture stands, and the items will likely be returned to Najib and Rosmah. RHB Bank recorded a 10% year-on-year growth in third quarter FY22 net profit owing to higher net fund-based income, absence of modification loss and lower expected credit losses. The lender's latest quarterly earnings rose to 700.5 million ringgit, while net interest income grew 8.4% to 1.1 billion ringgit. Gross loans and financing grew 5.7% year-to-date to 209.7 billion ringgit. This was mainly supported by growth in mortgage, auto finance, small and medium enterprise, commercial, as well as its markets of Singapore and Cambodia. Group MD and Group CEO Muhammad Rashid Mohammed said, while the country's economic growth is expected to be sustained for the rest of 2022, the outlook is challenging going into 2023, no thanks to strong headwinds from both the external and domestic fronts. Still, he highlighted that RHB Bank's fundamentals remain strong and it will continue to closely monitor its asset quality. RHB Bank traded 0.35% lower at 5.67 ringgit per share, giving it a market capitalisation of 24.08 billion ringgit. Hong Leong Financial Group, or HLFG, saw its first quarter FY23 net profit grow 6.4% on the back of higher contributions from its commercial banking division, which houses its 64% owned Hong Leong Bank, its insurance division HLA Holdings, and investment banking operation Hong Leong Capital, however, booked lower contributions. Net profit for the quarter rose to 681.74 million ringgit, while net interest income grew 6.2% to 1.01 billion ringgit. HLFG said earnings for HLA Holdings were affected by higher mark-to-market valuation losses on investments, as well as a lower share of profit from associates. As for the investment banking business, the group said its stockbroking operation was weighed by significantly lower Bursa Malaysia market activity, while its asset management segment was affected by lower management fee income. Meanwhile, Hong Leong Bank recorded a 14% growth in quarterly net profit to 981.41 million ringgit, driven by stronger interest income, effective cost management, low credit cost and robust contributions from associates. Net interest income rose 7.7% to 989.57 million ringgit. HLFG President and CEO Tan Kong Kun said, while the Malaysian economy is expected to remain resilient going forward, the recovery momentum would continue to face macroeconomic and external headwinds. Still, Hong Leong Bank Group MD and CEO Dominic Fuda said, the Malaysian economy is expected to grow 6.5% to 7% this year, before normalizing to 4 to 5% in 2023. Shares in Hong Leong Bank traded 0.19% higher at 20 ringgit 88 sen, giving the bank a market value of 45.26 billion ringgit. HLFG meanwhile settled 0.63% lower at 19 ringgit for a market capitalization of 21.8 billion ringgit. Ajinomoto Malaysia posted a 67.2% drop in its net profit for the second quarter of FY23, despite logging a 43.69% jump in its top line. Earnings totaled 2.94 million ringgit and revenue 158.15 million ringgit. The company blamed the weaker earnings on the 1.9 million ringgit operating loss its consumer business recorded due to the increase in the purchase prices of key raw materials and higher freight costs. Ajinomoto, which is relocating to its new factory complex in Seremban Negeri Sembilan, also incurred higher administrative and selling expenses, including staff costs, transitional costs related to the factory relocation, and sales promotion expenses in the current quarter. It also incurred 800,000 ringgit in other finance expenses. Meanwhile, revenue was boosted by higher contributions from its consumer business and industrial business segments on the back of higher sales volume and improved selling prices. Going forward, Ajinomoto expects the outlook to be challenging. In its filing today, the seasoning manufacturer said it will be looking at potentially disposing of the factory land in Kuchai Lama, Kuala Lumpur, where it has been operating since 1965. At the close, shares in Ajinomoto were up 0.35% at 11 ringgit 36 sen for a market capitalization of 690.67 million ringgit.